Welcome to Today Dollar Talks, the show where we break down the financial forces shaping our world in plain language. I'm your host, Alex Morgan. Today, we're exploring a question that affects everyone, whether you're an investor, a traveler, or just someone trying to protect your savings. Why do some currencies lose their value so dramatically against the US dollar? And what does that really mean for our lives? To help us understand this global puzzle, I'm joined by Dr. Laura Bennett. She's an economist, financial strategist, and one of the sharpest voices on currency markets I know. Laura, thank you for being here.
Thank you, Alex. It's great to be here. I love that you're tackling this topic because it's one of those things that sounds technical, currency devaluation, but it actually hits everyone's pocket in very real ways.
Exactly. You hear headlines about the peso collapsing or the lira tumbling, but most people don't stop to ask what that really means. Let's start right there. What does it mean when a currency devalues against the dollar?
At its core, Alex, it means that you need more of that local currency to buy one US dollar than before. Think of your national currency as a rope trying to hold on to a magnet, the dollar. Over time, that rope can start to loosen, and suddenly you need twice as much of it to hold the same weight.
That's such a clear way to see it.
Thanks. And the effects are wide-ranging. It's not just about exchange rates on the screen. It changes what people pay for imported goods, how much their salaries are worth, and even how governments handle debt.
So in everyday terms, a weaker currency basically means that life gets more expensive.
Exactly. Imported food, fuel, medicine, all of that costs more. The purchasing power of your money falls. For businesses, it can create chaos in pricing and planning. And for governments, it can make foreign debt almost impossible to repay.
So it's a chain reaction. A single movement in the exchange rate ripples through an entire economy.
Absolutely. And that's why devaluation is both an economic and a psychological event. It tells you how much confidence people have in their country's future.
Let's unpack that a bit. What are the most common reasons a currency starts losing value?
There are several. The most obvious one is inflation. When prices rise faster than wages, your currency buys less and less. You might still have the same amount of cash, but it stretches a lot less than before.
So, like having the same size wallet, but being able to fill fewer grocery bags.
Exactly. I often tell my students, inflation is like a slow leak in a glass of water. You don't notice at first, but the level keeps going down.
Si cae por debajo de
Then there
este
are
nivel,
fiscal and trade
cerramos la
deficits.
posición.
When a country spends more than it earns or imports far more than it exports, it needs to buy dollars to pay its bills. That demand for dollars pushes the local currency down.
And the interest rate factor, that's something we hear a lot about.
Yes, and it's a big one. When the U.S. Federal Reserve raises interest rates, investors tend to move their money into dollars because it feels safer and pays better returns. That strengthens the dollar, but it weakens currencies elsewhere, especially in emerging markets. The IMF has even found that when the gap between U.S. and emerging market interest rates narrows, those emerging currencies fall on average by about 4% against the dollar in a single year.
That's quite
Sell
a hit.
50,000 at 45.
And it helps
I need a price check
explain
on the
why
euro.
the
It's moving
dollar
too fast.
has
We
been
have
so
to hold.
strong
Get me
recently,
out of those bonds
while
right
others
now.
have struggled.
Exactly. It's not just local problems. Global conditions play a huge role.
Let's talk about some real-world cases because I think people understand best through examples. Which currencies have seen the worst devaluations in the past few years?
Lebanon is one of the most extreme cases. Since its banking collapse, the Lebanese pound has lost almost 90% of its value in a single year. To put that in perspective, on February 1st, 2023, the central bank officially devalued the currency by 90%. The official exchange rate jumped from 1,500 pounds per dollar to 15,000. And on the streets, it traded for almost 90,000.
That's unbelievable.
It's devastating. People saw their life savings vanish overnight. It's not just an economic story, it's a human one.
And Lebanon
Sell
isn't
50,000
alone.
at 45.
No,
I need
not
a
at
price
all.
check on the euro.
It's moving too
Argentina's
fast. We have
peso
to
has
hold.
also
Get me out of
collapsed
those bonds right now.
repeatedly. Between the end of 2022 and the end of 2023, It went from around 109 pesos per dollar to over 800. Then the new government devalued it by another 50% overnight to realign the official rate.
I can't even imagine what that must feel like for an average person.
Imagine waking up one morning to find that the same paycheck that bought a week's worth of groceries now buys 3 days' worth. That's devaluation in real life.
That's brutal.
It is, and it's not limited to Latin America. In 2024, Ethiopia floated its currency, the birr, allowing the market to set the rate. It fell almost 30% in one day. That was part of an IMF-backed reform plan, but it shocked the economy.
So whether we're talking about Argentina, Lebanon, or Ethiopia, the pattern seems to repeat. Inflation, policy changes, loss of confidence, and then collapse.
Exactly. You can also add Turkey's lira, South Sudan's pound, and Pakistan's rupee to the list too. All of them have faced the same downward spiral in recent years.
That brings me to something deeper. There's obviously the economic side, but isn't there a big emotional component too?
Yes, and that's one of the most fascinating parts of this topic. Money is built on trust. A currency works because people believe it will hold value tomorrow. When that trust breaks down, whether because of politics, corruption, or mismanagement, people rush to convert their savings into something safer, usually dollars.
So when fear sets in, it becomes a self-fulfilling prophecy.
Exactly. Economists call it capital flight, but it's really human emotion at work. Once panic spreads, exchange rates can spiral out of control in hours.
That's such a powerful reminder. We talk about markets as if they're machines, but at the end of the day, they're human behavior multiplied by millions.
Absolutely. If investors or citizens believe a currency will fall, their actions accelerate that fall. It's like everyone rushing out of a small boat at the same time. Even if the problem was small, the panic sinks it.
Let's bring it closer to home. What happens to everyday people and businesses when a currency collapses?
For individuals, imported goods immediately become more expensive. That's including essentials like fuel, food, and medicine. Salaries lose purchasing power if they're not adjusted, and debts, denominated in dollars, suddenly become much harder to pay. So even if your income doesn't change, your lifestyle gets more expensive overnight.
And for businesses,
It's just as disruptive. Importers face skyrocketing costs. Exporters might enjoy a temporary advantage because their goods look cheaper abroad. But if they rely on imported materials or dollar loans, that advantage disappears quickly.
it sounds like uncertainty becomes the new normal.
That's exactly it. Take Argentina again. When the peso devalued so drastically, companies that imported parts or machinery saw their costs double or triple. Consumers stopped spending. Confidence disappeared. It's a vicious cycle.
So, for anyone listening who lives in a country where the local currency isn't exactly stable, what can they do? How can individuals protect themselves?
The first rule is diversification. Don't keep all your savings in one currency, especially not in one that's under pressure. Hold part of your savings in stronger currencies like the dollar or euro. If you can, include tangible assets like real estate, commodities, or gold, things that tend to hold value even when currencies weaken.
So, spreading the risk between different forms of value.
Exactly. The second thing is awareness. Pay attention to economic indicators, inflation, foreign reserves, deficits, government announcements. Those are often the early warning signs.
That's a great point. We often wait for a crisis to hit before reacting.
Right. It's like ignoring the check engine light. For investors and businesses, tools like forward contracts or inflation-indexed bonds can help hedge against big swings. But even for everyday people, small steps like converting part of your income into a stable currency can make a big difference over time.
And I imagine mindset matters too.
Completely. The worst thing you can do during currency turmoil is panic. Governments sometimes announce sudden reforms, like floating a currency, and people rush to exchange money without understanding what's really happening. It's better to stay calm, stay informed, and make decisions based on data, not fear.
That's solid advice. I like how you bring in the psychological aspect, being prepared without being paranoid.
Exactly. Financial resilience isn't just about what you own, it's about how you think.
Listening to this, there's almost a philosophical layer to it. Devaluation shows how fragile confidence really is and how valuable stability becomes once it's gone.
I couldn't agree more. A currency is a social contract. It only works because people collectively believe in its value. Once that belief cracks, even the strongest institutions struggle to rebuild it.
That's a profound reminder that behind every exchange rate is a story about trust, credibility, and sometimes even identity.
Yes, and it's also a lesson for policymakers. Transparency and consistency are priceless. Economies don't need perfection, they need predictability.
And for individuals, it's about awareness and adaptability.